Hey, it's David here, CEO and founder of the Freedom Founders Mastermind community. Got an interesting article that I pulled from this past weekend's Wall Street Journal. I'll hold it up for you for a second so you can identify with it and you can go online, perhaps, or if you're a subscriber, you can pick this up. This is the Saturday, Sunday, November 13th, 14th edition of the Wall Street Journal, and this is in the Weekend Investor, which is the section B. The headline on this article is "The 4% Nest Egg Rule is Cracking. A strategy for funding our golden years is no longer foolproof. Retirees need to get creative." Now, interesting because this is what we have at Freedom Founders been, quote, preaching for the last 10 years. That the old model, this accumulation model, accumulate, particularly using the tax deferral strategy, which is 401ks, cash balance plans, defined benefit plans, all the stuff that your financial advisors tell you to do. Because why? Well, they get their hands on it. I mean, not literally, but they get to manage your money. It's what we call assets under management. And if they can get you to go for the tax deferral and put your money in these lock boxes, which means you can't touch it till you're 59 and a half years old, then they get to take it under management because you can't do anything with it. It takes it out of your hands. Anyway, their plan is that they're going to show you how you can take your money in your 401ks and retirement plans and whatever else your savings are and build up a certain amount of assets. And then when you, quote, retire, that is, you stop your active income, now you're going to rely on this nest egg. See, that's the accumulation model. Nest egg. Always talk about this nest egg. Well, how big should the nest egg be? Well, see, that's always the problem, right? So they have these algorithms and sophisticated proprietary software that tries to predict what you'll need. Here's the problem, though. That's what this article is bringing up. This is a model that was created back in the 90s. A model that back in the 90s when we went from high interest rates in the early 80s and high interest rates and high inflation, over 40 years, we've gone into much lower interest rates. In fact, historically low interest rates today. And until the last 12 months, very low inflation. But the tide is shifting, is it not? This is the problem. This is what people are finally starting to wake up and say, you know, this model we've been talking about, this 4% depletion rule that we thought most people could manage through their retirement years, not going to cut it. Let me read you a few excerpts from this. Let's talk about it just a little bit because it's important that you understand this. It says here that it says conventional wisdom recommends spending no more than 4% of savings in the first year of retirement and adjusting that amount annually to keep pace with inflation. Here's what's happening. Here's what they don't bring up in the article is oftentimes people retire when the markets, especially the financial markets, have been up, right? Like right now, like people retiring right now because, well, whatever you've done, your assets should be as optimized as possible right now because we've had this bull run market. It's not you, it's not your financial advisors. It's just we've been at a time where we've had a long run of an up market. It never stays that way. People retire out like right now. They think they've got this great nest egg, and what happens is like next year the markets take a tumble. They go through the correction. We're going to have a correction, and now this nest egg you thought you had, that 401k becomes a 201k, and either you've got to greatly diminish your lifestyle in retirement. Not really the time you want to do that, or it's back to the work. Hi ho, back to work we go. Not what people want to do, but I've seen this happen over and over again over the years, as many who thought they were retiring at a high point had no predictability of cash flow, no predictability of future wealth management, sustainability, preservation of capital, and no understanding of how to make it work. Why? Because they abdicated it. They did what everybody else said to do. Their CPAs, their financial advisors, financial planners. Yeah, just put your money on Wall Street and we've got these models that'll work out fine. Again, old models, old times, if they even worked, flat out don't work today. You've got to have a new playbook. What else? It says the 4% rule emerged as the wealth management industry standard in the 1990s, what I just got through saying. It says, however, this is no longer likely to work because future returns are expected to be lower following an extended period of above average gains, what I just said. It's a reversion to the mean. Whenever you have extraordinary or above normal returns, which we've had for this last number of years. Now, why? Just a little rabbit hole here. Why? Because we've had unprecedented federal stimulus, money printing, digital printing, fiat currency in the markets. Well, of course you're going to create asset bubbles, and of course you're going to create inflation. So none of this is real. But the point is, we're going to have a reversion to the mean, which means the correction when you have a long up market is likely to be pretty significant. Now, I have no magic crystal ball. I'm not telling you when, how, but if you're not at least thinking about needing to hedge your downside risk and knowing how to do that, do you have other places you could be putting your money right now? Have you learned anything in your life besides your specialized training that you have that makes income? But when you're not earning that income by trading time for dollars anymore, you've lost the ability to keep up with inflation. You've lost the ability to recover when you have a downturn in the markets. This is why I love what we do in Freedom Founders, because we learn how to orchestrate our asset protection and management in alternative assets. Now, it takes more time. It takes due diligence. It takes doing a little bit of work. But to see the skill sets to learn how to do that before you get to retirement, it's life-changing. It's absolutely life-changing. And then these are these skill sets you can pass on to your kids and grandkids, because if you care about legacy, whatever that means to you, how are you going to pass that on? You just don't give money to your kids or grandkids. I mean, you can, but what if they don't know what to do with it? See, the times have changed. People don't realize how much they're being left behind because of the volatility that our government has created. No fault of ours, but we have to live with it. We have to live with it. All right, what else? It says that it's counterintuitive, but when the stock market and stock valuations are high, it's the worst time to retire. That's what I said earlier. Because when you retire, when you think you've got it made, because you've got this nest egg, it looks really good because we've had this last bull run market of 8 or 9 years. And then next year, after you retire, bam, because you didn't know how to hedge. You didn't know how to put your assets in a model that could sustain you. Again, I won't go into the rabbit hole of what we do with real estate. Not that real estate is not affected by economic downturns, but there's a lot more opportunity to hedge and keep those downturns and keep still the cash flow moving, which it's all about. It's about cash flow, not accumulation. It's about the cash flow. And if you've been in with your financial advisors, they've never talked to you about cash flow. Oh yeah, there's a few dividend paying stocks, but they're about accumulating. It's not the way it works in the real world. This is not how you do it. Tangible assets are what's going to carry the day for you, but you've got to learn how to do this. You've got to have connections. You've got to have access to the deal flow, and that takes a little bit of work. It says there's 3 ways retirees can still spend more than, now they're saying 3% instead of 4%. If they're willing to be flexible. Now, here's your options, right? 1, you can opt to work longer. Well, hello, that's kind of obvious, but was that really your plan when you started working 30 years ago to actually have to work into your 60s and 70s? I don't think that's probably the plan, but many people will have to do that. Or it says you can delay the year you start taking Social Security. Whoop-de-doo. I mean, how much difference is that going to make? Yeah, there is a difference if you wait till you're 70 years old before you start taking Social Security. But my goodness, that's a few $1,000s at most for most high-income earners. That's not going to change the model for you at all. So these alternatives, these options, doesn't look like a plan to me. It says, but there may be a downside. While your nominal income may remain steady, that means the cash flow that's coming out of whatever denomination, Social Security or annuities or whatever you've got, that may stay steady, but it's not inflation adjusted. Here's what they say. Your inflation adjusted income is likely to decline over time. Well, yes, when you have inflation against a regular predictable income stream, wherever that's coming from your retirement plan, your dividends, your annuities, that's going to be eaten up by inflation. Do you know that just at 5% inflation in 10 years, your dollar loses 40% of its purchasing power? That's in 10 years, 5% inflation. Well, we've already beat that this last month. We're looking for probably hitting 8% inflation next year. Remember, go back to the 70s, 65 to about 82, that 70s period, we were up pressing above 15% inflation for a number of years. Probably the average was well over 6%. This model is not going to work for you going forward. You need a new playbook. Bottom line is, I'll finish this off. We'll cut it short. It says, many of today's retirees will have to be more resourceful to support their income needs, Morningstar said in their report. Yep, I think a little bit more resourceful is probably going to be the key for most people. But how do you become more resourceful? You've got to learn some skill sets. You've got to do a little bit more than just putting your money with the market, giving it to financial advisors, put it in 401ks. That model, if it ever worked, is far gone today. It's up to you to govern and advocate for your future. No one else is going to do it but you. That's what we do in Freedom Founders. That's where we have models that go into alternatives, and we have the connections and access to make this really work. And the peace of mind and stability and security and certainty it gives our members is what changes people's lives. Remember, always stay focused on your freedom. I hope to talk to you soon.